Hey everybody, super happy to be here once again. And today I'm having Oded Shimoni. Oded is the CEO of AlphaBeta, and today we're going to be talking about the most general topics when it comes to ETFs, constructing an ETF, what it takes, and the quantitative background behind it. And I'm super happy and super excited to have you here, Oded. So first and foremost, how are you today? Hope everything is good on your end. And before we get started, I would love if you can present yourself to the audience so they will know our guest for today.
Sure. Thanks, Afek, for having me. It's a pleasure. My name is Oded. I'm CEO of AlphaBeta. We're a quantitative R&D company specializing in systematic strategies, focusing on low correlation strategies, where we use different types of statistical models to power investment products, mutual funds, alternative ETFs, hedge funds, tracking funds, powering multiple issuers globally. That's what we do in a nutshell.
About low correlation strategies. I think that that's a specific topic we haven't really touched in specific within the podcast. So I would love to dive deep into the research and development of a trading strategy that has low correlation. So how it actually get orchestrated? How do you think of alpha generation in low correlation strategies? What it actually mean to the research and development process?
That's a great question. Usually, we specialize in the equity space. So usually when you talk about low correlation, you're predominantly speaking about long-short strategies. And this is where quantitative tools can offer a lot of added value to the process. So if you think about shorting as something that takes for a discretionary manager a lot of specialties, know-how about a specific company, its financials, accounting practices. And this is usually a practice where for a discretionary manager, you have a very strong view that the company, a specific company, is going to drop in value. This is a highly specialized activity, which poses risks due to the fact that stock can go up more than 100%, so a lot of capital at risk. So where quantitative asset management really helps in this space is the ability to scan hundreds or thousands of securities for a given geography or globally, and build a portfolio that uses a lot of names as opposed to a few specified names in a portfolio, which naturally reduces the risk because the weight for every single name is lower. And you are then able to scan through multiple names, maybe hundreds of positions, and do it across the globe in a systematic way where you rank stocks by a given set of criteria, which are objective. Today, most of what we do involve more sophisticated statistical models, machine learning and deep learning models to try to allocate to stocks long and stocks short with a really, really broad portfolio of securities, usually in the hundreds of positions. Another way you can approach low correlation is via strategies that have some sort of capacity to do so without shorting. A good example would be merger arbitrage. So in a merger arbitrage, once a company announces that it's acquiring another company, the the value of the target company jumps in price, but not all the way to the target price, because there's basically two things that you need to still get compensated for. One is the time until deal closure, and the second is the probability of deal failure. So what usually happens on, say, plain vanilla deals is that the target price, the target company deviates completely from the market, or almost completely from the market, and it sort of starts behaving more like a cash instrument, which introduces low correlation to the market. So even in the recent sell-off that we had last month, you saw that systematic merger strategies performed relatively well compared to the market, even though the underlying securities is equities, and even though the overall exposure is still positive.
It's a very interesting topic because you gave us a hint about how do you actually craft a portfolio of strategies, and a thing that I get really interested to talk about is the weights of each and every ticker that you have in your portfolio. Now, I guess that you have multiple tickers, and allocating the weights and actually measuring the weights properly across all the portfolio and giving each and every ticker the rightest weight within your portfolio. It's a mission by itself, and that's the entire risk management that you're doing in the backstage. And I would like to ask you how the weight allocation is actually spread all across the portfolio. What do you think about it? And another topic which I would love to deep further on is deep learning and machine learning. You have mentioned that you're using deep learning for weight allocation, and that's a topic that stand still in front of most of the quants in order to understand how to use those techniques properly. So let's start from weight allocation in the portfolio, and then let's talk about how actually being used in practice using those techniques and technologies.
Yeah. So obviously a pretty broad topic, but I'll try to be as specific as possible. So
Yes, it is.
the way that we approach weight allocation in these types of long short portfolios is via pretty simple optimizations, but the optimization itself is sometimes being done on a given aspects of the portfolio, which are not necessarily the historical returns. What do I mean? So, for example, you could take a systematic approach that uses established academic factors. There are more than 150 factors of these cited in academic research today. And
Is it not dangerous? Like I know that I know from my experience that trying to deploy academic factors in a sense might be a bit complicated, or it might be a bit disconnected with the actual reality of the financial market. So how do you actually approach those academic factors properly?
so, in essence, these types of investment factors are what drives most of the returns for portfolios. The historical way, if you think of factor investing, of how it was done, was that these factors were discovered in academic research, or started to being laid out more than 30 years ago, 40 years ago. And the academic research started to find a lot of exploitable anomalies. A very common one, very well known, is the momentum effect. It has a lot of explanations, both behavioral and financial, but mostly behavioral, because it shouldn't work, but still does
Mm.
in most of the world. Um, and and the classical approach would be to get some sort of exposure to momentum or value, but this is very cyclical, right? So we all know that, for example, the value family of factors didn't work for like a decade, right? Or until the recent 5 years. And what you did historically was to combine these types of investment factors in some sort of a set weight allocation. Um, you could have maybe introduced some dynamism there, but the classical approach was this multi-factor approach where you take some momentum, some quality, some value, some low volatility, and construct a portfolio with stocks that have reasonably high scores across these types of factor exposures. Now, the recent discoveries in academic research and the way that the research is heading over the last 6, 7 years is almost entirely of using more advanced machine learning and statistical tools to dynamically allocate across these factor exposures. So what you are left with is our portfolios that try to every month or every week or whatever the rebalance frequency change or slightly change the weight allocation for a given factor based off of the machine learning predictions. This is a key focus for us and something we specialize in. So when it comes to the uses of factors, then if you understand that these types of anomalies or factors are still acting as drivers of returns per a given time frame, they could change, they could not work for a while, but for given periods they do generate returns. Then what you're trying to do is find ways to systematically allocate across these for a given point in time.
How
So
complicated is how complicated is it to find or allocate the weights properly? Because I do follow across all academic research that have been done in the past a year or two very tightly, and I see that although the technology advances very rapidly, there are some professors and some well-known authorities in the industry itself that don't really recommend using machine learning. And the reason they don't really recommend to use machine learning is because the challenge of interpretability, and having a machine learning set it up to allocate weights might be a bit challenging because it will not expose you to the actual decision making process, although it's very powerful. It's a very powerful methodology overall. And my question is, or my hypothesis here that I want to discuss with you about is, okay, let's hypothetically assume that you have used machine learning. How do you, or where do you actually uh, uh, put that technique within your architecture in order to allocate weights properly, having the ability to see what exactly causes the uh, uh, the prediction or the estimation of the model, and how do you use it with confidence within your weight allocation process in order to understand exactly how do you allocate weights, how do you split it across all the tickers within your portfolio, and the data. How do you actually making sure that the data and the artifacts that input to the model are actually very reliable, that you can actually train a model with. So those are
yeah,
two separated questions, but I do think that they correlate to each other in a sense that makes the question built and have and sounds very complicated.
yeah, these are all very good points. So you want to use features that have, or the way that we see it, we want to use features that have economic significance. This is why using factors, even though some of them might have been biased in many ways, but you want to use stuff that has already been well researched and understood. This is how we approach it. And then the goal is to find a way to extract the most information and allocate the weights, as you mentioned, in the optimal way. So if you're sitting on these underlying features that have either economic rationale or behavioral rationale that you can explain, you using stuff that or should be or could be more reliable than using some sort of stochastic variable that you pull from random data. Then your role is to weight them, and it turns out that machines do it better than humans. So the way that you can approach this, there are many different ways to use it to do that, but
Can we talk about the methodology,
yeah,
like
sure.
gradient boosting model, linear regression? What type of model do you actually use in order to understand, or in order to understand the architecture itself, with the decision-making process or the estimation that the model actually predicts?
Yeah, so there are many different tools and ways you can use different models and then try to combine the predictions or the weight allocation to come up with some sort of an ensemble process where you use multiple, you can think of it as multiple opinions of different models and try to reduce the error between the predictions using different types of models. The main architecture that we are seeing that works well or historically worked well is using these types of features to extract linear combinations of or linear or non-linear combinations of these variables in a way that explains factor portfolios, and then you try to optimize across these portfolios and then map again to the underlying securities. So
Mhm.
you optimize for factor portfolios and then map again to the underlying securities, which generates weights. And then the whole secret sauce is how you combine the different weights, what you do with the allocation, etc. That's the overall uh, guiding idea of the process. And there are many different models and tools that you can use. Then the question becomes, how do you do it? And every firm or every
Yeah, much more
quantitative,
general. Yeah.
every firm or quantitative R&D company uses something a bit different. And this is where you either succeed or fail.
Mm. That's a brilliant approach, using an ensemble model. I do think that not having one total reliance over one model or one methodology makes sense to actually have a diversified approach. And I will look. Let's hypothetically say that, okay, you're after the generation of all those type of models that you're using in your research process. And right now you're facing in front of all of the weights the models have been generated. And now the game itself is to allocate all those weights properly. So how do you actually make those connections in between the weights all across the models for a specific ticker? How do you actually estimate the rightest weight? Is it do you use another model in order to combine everything in understanding the statistical difference in between the deviation in the weight itself, and the proper allocation methodology that you're actually using in order to allocate, understanding how you allocate weights and allocate the weights, on top of all of the expectations that the models have executed.
Yeah, so that's a great question, and I don't think there's a clear right answer there. A simple approach would be to combine between, if you're using the same universe of securities, to combine the different weights of the models has its advantages, has its disadvantages. But the underlying question does it make sense to combine the weights in this way? And this is where you need to apply different types of normalization processes, etc. And what you mentioned as well is also something that's done quite regularly, which is trying to time the models, right? So that's another layer that you can try to use on top of an existing architecture. But it adds another layer of complexity, and then you need to make a decision whether it's worthwhile to introduce that or to still use something which is might be more simplistic, but uh, would still work.
Mhm. Got it. Okay. Well, obviously, it's an interesting topic. And recently, there is a very famous conference. If you're familiar with, it's called ICLR. And recently, I saw Susquehanna posting a video with Ali Naziri. Ali Naziri is the head of deep learning in Susquehanna, and he said that they're actually deploying deep learning in a very specific manner to extract patterns from the market. And that really, draws most of the industry attention to the methodology that Susquehanna actually pinpoint to, because the usage of deep learning, which is not interpretable at all, into the uncertainty as an environment for example the financial markets, and combining everything into a reliable pattern that you actually can exploit in a market, or you actually can take and explain and articulate its characteristic to a GM. It might be a very complicated mission, complicated task to do. And my question to you is that recently you have mentioned that you're using machine learning and deep learning, and deep learning is obviously something that caught everybody's interest due to its incredible capability to detect underlying connections. But detecting underlying connection not necessarily mean that you're going to be understanding the connection itself fully from end to end. And I would like to ask you then, how do you actually deploy a deep learning methodology on what, where, and how do you actually extract the rightest data that you need in order to have another intelligence type of understanding of what do you need to do within weight allocation inside of your portfolio.
Yeah, so I think that I might be wrong, but I think that Susquehanna are using it in more microstructure, high frequency type of ideas as it relate to their activity. I might be wrong, but and this is something that you have a lot more data too, and in theory,
Yeah, obviously microstructure.
yeah, in theory should help you gather insights that humans are
Not
can
capable
do,
of.
incapable
Yeah,
of doing, right?
incapable of actual locating. Yeah.
Yeah. There was a recent paper actually that used uh, new types of of deep learning similar to LLMs to try to predict this type of patterns uh, in the microstructure. It's a paper that's getting a lot of interest right now because it was then they did some sort of transferred learning and put it in different markets, and they found patterns that are much higher than the baseline. So it's gaining some attention. This entire space, as you mentioned, our usage is we're not really in HFT and these types of ideas. We're sort of more long-term oriented. So
Mhm.
our deployment of deep learning is still consistent with what I mentioned previously. And what you would see is that once you use established features from academia, you're still getting something which is correlated to other types of model. So it doesn't come up with something dramatically different if given the fact that you're in the same universe. But it adds diversification, right? So you can then do some sort of post-hoc analysis on the stock selection and understand, I can actually understand what drove the decision there using these types of exposures. And this helps reduce a lot of the issues that you mentioned about unexplainability. But when it comes down to it, there is a measure you need to trust the process and what you did and the model and how it behaves. So you need to understand the process deeply. You need to trust it, and you need to verify that you're generating both historically and out of sample results that are statistically significant, stable. There are different ways to measure that, and that's our approach to it.
Mm, very interesting. Okay, so so we have spoken about the output of the models, how you actually work with the output, but let's talk about the input and about the artifacts that you're actually plugging into the model as an input. And I would like to talk about the data. What process do you have for cleaning the data? We have spoken here about PCA, SPD, IVPs, everything statistically that can actually extract the underlying connections even before training the model in order to be much more easy to articulate before the trading process. And I would like to ask you, how is the data cleaning process or how do you see it? How do you see retrieving the data? How do you see cleaning the data? How do you see organizing it properly in order to train upon the time series framework that you would know in order to extract the most of the model itself?
Yeah, so a great question again. So, first of all, we usually focus on very liquid universes. This solves a lot of the issues that people face because the more liquid the universe, the higher quality of data naturally. Then you still have issues. You always have issues with data. There's no clean solution for every scenario. There are certain ideas used today where you cross-sectionally map out the different correlations, and you can use even simple tools like linear regression to impute the data for missing securities. Obviously, everything before it goes into the model gets normalized cross-sectionally, and that's the main tools I think used right now. You want to have a reasonable way to impute data which you can defend economically, which makes sense, and you want to be able not introduce any types of biases to your data. So you don't want to drop some.
Which is a very complicated mission by itself.
Yeah. So, but you need to verify that you're doing the basics correctly, right? So not dropping observations because of missing data, because stock might have been delisted or whatever. So this sort of introduces biases to your estimates. So you need to do the basics right. Then when it comes to imputing, there's many different ways, but generally you would try to come up with something that's economically reasonable to impute the data. Then you normalize it. That's the general structure, I think, which makes sense.
Okay, and how do you actually back the data economically that makes sense before you impute it? What are the main factors that you're looking at? Obviously, you're messing with high liquid asset types, and it makes everything much more organized. But still, you have the question in order to understand what actually backs up the data economically, and I would love to hear your opinion about it.
Yeah. So in general, you need to use very high quality data provider. This is expensive and
But this
and not
this
not
is mandatory.
not always 100% reliable, but this is the starting point. You want to verify that you're using the best quality data that's possible for these types of models. And then you need to verify that you've done everything you can. One other thing that's commonly used is introducing a lag to the data, which sort of solves a lot of look-ahead bias issues. At least cross-sectionally, you always do that to verify that there hasn't been anything that leaked. So you want always the companies to be. This solves a lot of issues when you put what they have the similar type of reporting time. So if a company reports in Q1, but one reporting in March, one in April, one in May, one in June, whatever, right? So you need to introduce some sort of lag, so you have all the data talking about the same time period, right? So you need to know the dates of when the reports were published. You need to know, you need to introduce lag so everything speaks in the same language. So you don't have this company already ported and it's already introduces some sort of want everything to speak in the same way. So these are pretty basic stuff, but it's very
Yeah, but this is
important, and then another time not being done correctly.
Yeah, but this is very general approach. But what about company splits? What about company dividend reports? What about obviously reporting season? It is a high impact, and I said with Professor Paul Bilak, and I think he told me that 80% of an equity movement over the past 15 or 20 years is due to earning reports. And it's very interesting to look at when you're actually talking about cleaning the data and understanding the data, because um, although you're working cross-sectional, and there are the most basic and general things to do, like not leaking into data, avoiding look-ahead bias, ensuring that everything is talking in the same format, and so on and so forth. You do have still mandatory issues to take care of, which are uh, completely hidden in some of the cases, like company reports, understanding the section itself, talking or organizing the data as supposed to be organized in a way before you actually train the model. How do you approach deeper layers of working with the data that you're retrieving from the data provider?
Yeah, so you use this the issue that you're trying to solve is you're trying to predict next month or next week return, whatever, right? So what you need to verify is that all the information is point in time. And then your target variable is what you're trying to predict. It's baking already whatever was done. You need to obviously normalize the prices for whatever dividend, etc. You need to do it in a correct way, which is not easy. Um, and you need to once your target output is the variable and it's baking all of this information that you just mentioned. If you're finding some sort of connections there, then you are then able to
In the
optimize and
data.
allocate. Yeah, you're then able to optimize and allocate. If your target variable is this prediction, then then it comes down to whether the model picked up on anything related to the underlying feature with your target output variable.
Mhm. Okay. And okay, so taking the data, collecting the data, find trying to find impacting components. Is it a thing that you're actually doing within your data research before plugging into the model?
Yes, of course, you'll do all the basic stuff when it's relating to exploratory analysis of the data set before you head into to anything. It's basic, work to have a look at the data, look at it in many different ways, correlation, box plots, see what's missing, try
Hmm.
to formulate an approach that makes sense. This is a basic part of every process, and this makes for the model much more reliable later. and then the products that are being generated from it and the strategies.
Mhm. Okay, very interesting. Um, so overall, I think that we have covered everything. Well, we tried at least to cover everything, and I would like to jump on the next topic, which makes me very interesting, make me very interested to speak about, which is EDF construction and what do you do in Alpha Beta. So I would love if you can expose us a little bit to the world of actually constructing an ETF, how it actually works when you're thinking of launching a new investment product. How do you organize it properly? How do you find the rightest partners to work with? And how the process in general actually works until you public the instrument.
Yeah, sure. So we, just as a quick background, we basically with throughout our different partners, and we recently partnered with Wisdom Tree more strategically. Um, with our different partners, we provide the models behind the ETFs, right? So ETFs is the most insane innovation in financial markets over the past 30 years. It's a 13, $14 trillion industry growing really quickly. And over the last 5 years, there have been dramatic innovation in this space. So once the derivatives rule passed in 2020, this now allows to basically put hedge fund-like strategies within an ETF structure. It allowed the use for leverage in a much more systematic and way, which is defined basically by risk, and this allows to do all sorts of unique things within an ETF structure. So if you think about the world of hedge funds being for accredited investors, um, sometimes with lockup periods, with success fee and management fee, then ETFs are transparent, liquid, um, without success fee. So it's a really huge move that was done in the US and introduces a lot of new things that you can do. So what you saw since then is that active ETFs really took off, right? For many different reasons. One is the strategies, and the other one is tax purposes. Let's not go into that. But there's huge innovation going on, and different types of tools and ideas that you can use in an ETF. This generated a whole new uh, approach where you can put very alternative strategies, low correlation strategies inside ETF. So this entire space is pretty young. It's growing quickly. The active and liquid alternative space. There are many types of vehicles now out there which incorporate these types of ideas. So portable alpha constructs where you take a broad market beta exposure overlaid with some sort of uncorrelated alpha source, which is a huge movement, and it's going to be a pretty huge category because an investor could potentially get the exposure that he had to whatever the S&P treasuries or whatever, and get another with the same dollar, get another set of exposures to uncorrelated sources of return. So it could be many different things, right? So insured equity, merger arb, this type of ideas. And if the strategies are really uncorrelated, then you also get diversification effect, and you mathematically shouldn't increase the standard deviation dramatically. You still introduce uh, you should introduce more volatility because you are taking leverage. But if it's truly uncorrelated, then you're not really increasing the standard deviation. There's also pure plays types of strategies that's currently going on. Um, Migration of trend following CTA type of ideas into ETFs is is pretty big and successful. And I see this space going more and quickly. Now, we come in with our partners as constructing these ideas. We do it via models or data or through index provision. This is basically what we do. So we partner with issuers to uh, to then take these ideas to market, and we sort of power these types of vehicles.
No, it's very interesting because the amount of diversification you're actually allowed to stack in a particular ETF gets very very wide. So the diversification itself gets very very interesting. And you have mentioned that if you're deviating the correlation a little bit more than it's supposed to be profoundly, you're in a serious danger. But having a type of but having a very wide diversification within your ADF itself will cause some sort of deviation in between the asset itself that you need to take care of. So that's a very mathematical or very nuanced question. But I would like to understand, how do you actually have or place a great diversification with your ETF, but still how to not deviate from the correlation within your ETF, so you keep it very very professional, very profound mathematically, and yeah.
Yeah, so it's you need to take into account when you're constructing these types of portable alpha concept about capital efficiency. Basically, if your strategy, your alpha source is beating the financing rate, you're adding value, and it's uncorrelated. You're adding value. So this is what makes this very attractive, right? So you check for correlations, you check for your beta exposure to whatever broad market exposure you're taking. Doesn't matter if it's S&Ps, Treasuries, Nasdaq, whatever. You check in the beta when the markets go down, check it when the market goes up, and see how the strategy performed in different stress periods. And overall, what's the correlation? Assuming that you are able to generate positive returns, which are uncorrelated and preferably most stable as possible, then that's really huge innovation and something which is going to take a lot of place, I think, going forward in ETFs. It's going to be a large category.
Mhm. Okay. That's interesting, but I would like to get one layer even deeper, and thinking about capital efficiency and its distribution across the ETF. I would like to ask you about, how do you actually construct an ETF internally? So in terms of understanding what type of asset, what type of strategies do you like to approach each and every single asset type within your ETF, so everything will efficiently get allocated, and the ETF will construct perfectly, so it won't deviate, and the correlation will remain very sustainable.
So it's actually a lot, that part is a lot simpler than it sounds. When you're doing a portable alpha construct,
So
you
so so it's
basically,
it's me who makes it more and maybe makes it more
may,
complicated.
maybe
I take the bet.
let's dive deeper. So the entire idea is that you have $100, right? And you're using that entire $100 to buy a futures contract, a derivative of whatever broad market exposure you want. Now, what's going on there? Well, once you buy this beta exposure, you export to a market 100%. So naturally, what you get is something which is highly correlated to whatever market exposure you want. Where's the issue? What do you need to to make this work in a successful way? since derivatives don't require you to put the entire cash in the instrument, you're now sitting on
Yeah,
whatever
obviously
nine.
you can leverage.
You now have, it's not only the fact that you can leverage, that's the underlying idea, but now the future contract is trading at a premium to the market because you're sitting on idle cash. And usually what you do is you deposit it and you earn the risk-free rate, and then you get something which is pretty similar to the market. But the idea with portable alpha is you're taking this this cash component and you're using it to invest in something which is uncorrelated to or should be uncorrelated to the broad market exposure that you're taking. Then the question solely becomes, are you able to, with something which is uncorrelated, beat this financing gap, which basically is the risk-free rate, beat the risk-free
Mhm.
rate, and whatever management fee is being accrued. And if you do so, you're adding value. It's pretty simple. So you now have a vehicle which tracks the market pretty well with high correlation, more than 90% usually. But, um, you know, with the goal of generating some sort of added value there, either through diversification or access return. That's the entire, concept behind this, and it's very interesting development.
Mhm. Why do you think it's a very interesting development?
So, because it wasn't possible in the past to do so, and it makes a lot of sense, a lot of economic sense if you are able to generate something that has positive returns, which is higher than the risk-free rate, right? And it's uncorrelated, you, in theory, should receive higher returns with similar levels of risk. Similar. Still, risk still goes up incrementally, but if it's uncorrelated to equity markets, then you're basically getting very similar exposure with slightly higher, potentially higher returns. Now,
Mhm.
why is this interesting? Because allocators and retail investors and everyone and still is and probably should be the core of every portfolio should probably still be broad market exposures, right? So you still want to be exposed to the S&P, you still want to be exposed to equity markets, right? For most investors, that um, probably is the approach to go. And what this concept does is to basically allow for this continued usage of broad market exposure, but with the added benefits of diversification, potentially increasing returns without dramatically increasing the risk. That's the innovation here, I think, and this is what makes this extremely interesting. So you're not asking for either the allocator or the investor to completely exit the S&P and put something else instead, like a thematic whatever idea. You keep the market exposure, you get something extra on top. Uh, this might be compelling to certain investors.
And for you, well, you're an R&D company, but I think that when you're actually working with a partner, having said that they are highly exposed to the equity and the S&P, uh, makes much more sense for them to with the instrument that you have built, and obviously getting exposed to the equity markets gets tricky or not. I would love to uncover the topic with you, because although you're exposed to a very liquid market, makes it much more like takes the asset that you have built and increases the amount of reliance to the equity market. And if the equity market is in a serious trouble, you need to have a counter effect within your ADF in order to defend it. So that makes the entire construction much more interesting, in order to understand, okay, so you would like to have a certain exposure to a certain market. Okay, so how do you defend it? And you have the capability to defend it. So I would like to understand how do you strategically think about a move when you're exposing to a market, and what type of asset types? Well, obviously, it's a very economical, and very market-based discussion. But how do you, apply the right strategies in order to defend correctly the exposure that you have selected to have within your ADF?
I'll answer this in a slightly different way. So, what we do is construct different types of exposures, which tend to be uncorrelated to bond markets. Now, when you put aside ETFs, when you combine different sources of alpha, different types of alpha engines like this, or different types of sources of returns which are uncorrelated, and you combine them together, and hopefully between themselves they're not correlated as well, you're getting a you're targeting a return stream that is very diversified and potentially very stable. Now, this is this is the diversification effect. This is nothing that we invented, but this is what the largest quant shops in the world do in hedge funds. You're trying to stack a lot of uncorrelated alpha sources to try to generate something which is pretty smooth, might not generate huge returns, but it's pretty stable, low drawdowns, low standard deviation, and that's what we focus on doing. And we apply this type of ideas in different ways. I think ETFs would go there eventually, but they are still
In what sense they
complexity.
will go there?
They will. You would see this type of multi-strat approach in ETFs succeeding in the future. It's not didn't do amazingly well in the past, but you will see it succeed in the future as the market advance. Because this introduces complexity. We put a lot of different sources of assets, futures, options, equities, derivatives. This is still much easier to do inside of managed account or hedge fund structure. It's much easier still to do that. In ETFs, it's more complicated. It's doable, and you would see it in the future succeed. This is what I estimate.
Do you actually think that as long as market advances and the market gets much more efficient, having a sort of an ETF like we're talking about will be a possibility and will be actual doable?
It is doable right now. It's just the fact that there's not a lot of these that have succeeded historically. And what I think is going to happen is that you're going to see this in ETFs and succeed going down the line, much more of these types of ideas. So this as a side. So if you're looking about the idea of something, of an asset which is uncorrelated, completely uncorrelated, there are pure play alpha types of angles in the ETF space. But what we're seeing still is mostly with the stacked returns and portable alpha ideas, because the market is still maturing and all that. I think you will see it in the future, but so there are like pure downside protection vehicles, pure not really clear, like really clear and really successful multi-strats that you would see in the future.
If there is a thing that I really like about the podcast itself, is because we discover a lot of approaches to tackle the market, and obviously we had some PMs over, and everyone has its own hypothesis in order to tackle an approaching market. And my question to you is, because your standpoint is very interesting. They claim that as long as the market gets much more efficient, their alpha generation process will evolve with it. And you say that your type of alpha generation is not necessarily relate to market advancement, in such a point, but you already have an underlying understanding of where the market will go as it will be much more advanced, and how to deploy different alpha generation engines within an ETF itself. So my view to you is about alpha generation engines nowadays. How do you think an alpha generation um, engine is supposed to be built architecturally in order to tackle the investments of the future market events that will obviously make it much more advanced?
Yeah, so this is a philosophical topic. Alpha sources.
You will get a PhD by the end of
Yeah,
by the end
so
of the
yeah,
conversation.
so alpha sources they change. Models need to adapt. Uh, you know, things mature, things that decay. You always need to innovate, improve, do things a bit differently. What you need to establish is a clear process and a clean process and a process that makes sense, and both economically and preferably intuitively as well. This is the way to do it, but innovation has to happen continuously. Otherwise, things change through time.
Mhm.
Um, that's why you need to keep the working on more alpha sources, more diversification, more ideas. In a general way. When it comes to portfolio construction, um, either you're sitting on very established sort of premiums that you systematically collecting or harvesting in a way that makes sense and in a way that's potentially adaptive, or you keep generating new stuff and adding diversification through time. I mean, things could work for 5 years, then stop, then you do something else. It's pretty natural.
Okay, so if we already went into a very philosophical discussion, we have spoken about academic advancement in the field, and how it actually gets translated into actual innovation in the financial market. And my question or wonder that I would like to share with you is about how do you actually capture a paper uh, from archive by Cornell University or Google Scholar, and how do you actually battle test it with reality in order to understand what type of considerations or value proposition that you can take out of it?
Great question. So there's a huge difference between ideas in academic research and real life investment management. And it's a pretty unique specialty that's hard to do and develop. So this could come from very basic things like that's not done always in the academic papers to more advanced things that need to be done. But in a basic sense, when you're constructing these types of ideas and long short portfolios, you need to take into account a lot of things like actual liquidity, borrow fees, locates, tradable universes. Usually, it's not something, whatever described in the paper is not something you can do. And in most cases, when you battle test it, as you mentioned, you do not see whatever was published on the paper, right? Occasionally, you come up with something that could be used in real life. And then
Mhm.
the goal is to find ideas that make sense and you can use on actual market constraints that make sense. And there's hundreds of examples of things that you need to do and check for that. Uh, for the different types of things I mentioned, for assuming you're trading the close at the same time you're doing the calculations, many different ways that are not always explicitly handled, right? So
Mhm.
Some ideas are good, most aren't, and it's a pretty unique specialty to be able to get ideas from academic research to work in real life.
Mhm. And let's hypothetically let's diverge from that topic and conversation onto your role as a CEO, which is a very interesting topic to talk about. Um, let's talk about thing that I think that drives the curiosity for the majority of the audience is about fundraising processes. Now you're an R&D company and you work with multiple partners, and I think that you're exposed to a lot of fundraising processes and a lot of portfolio managers. um, so what do you think, or how do you see a fundraising process for a hedge fund will be or will look like in the current year or two?
Depending on the market, I can speak on our local market that it's very uh, family office oriented, not a lot else going on, right? So the main distribution channel is of our family offices. What you would usually see, and it's a very measurable business. You need to, at the end of each month, there's a number on a fact sheet, and it keeps you accountable. Are you accountable to what you're saying you're trying to achieve? And presumably, if the product itself that you're selling is something that interests the allocators, family offices, has a role in a portfolio, and you're doing what you're saying you should do, and then will get allocated. Now, here locally, it's the main distribution channel. Um, Abroad, it could be different types of there are some institutional processes here, but it's predominantly family office locations.
Okay, so Oded, just to wrap up today's conversation, we have spoken a lot about deep learning, machine learning deployment, research procedures, EDF, and quantitization of different asset types into the EDF itself, market advancement, philosophical topics. Um, but the last question I have for you, which is a thing that I do with every guest that comes here, is to ask or to wonder about your personal opinion about where the market will be going to. What do you think about emerging and established markets? Where do you think the innovation will actually look like in terms of your understanding and your type of participation within the markets? And I think that could heavily reflect over the entire conversation that we had. But it is very interesting to ask your own, like, dad's perspective on the market, not a part of, AlphaBeta or not a part of your expertise, but just your honest opinion where everything will look like in a year or two, and how you see your internal development as a CEO evolved in the market within its involvement.
So a lot of different points. Generally, I think we're at a pretty historical period in terms of where things are and where things are going. Um, so it's truly impossible to predict. We can try, but we're at a situation where it's not only like companies and technologies and where it's going. It's a lot being shaped right now by geopolitics and things that are much more difficult to predict, and not in my honestly not in my capability set. right? What
If you were a part of the White House, it might be much easier
maybe,
to determine.
maybe,
It might be, might be.
based on the poly markets and the, no. But in general, what this implies, I think, is that you should, or what I think is a positive approach is to keep on diversification and diversifying your portfolio and understanding what lines are in your portfolio, what are they doing, what purpose are they doing, what are they trying to serve, understand the correlation between the different securities and strategies. And today, even for retail investors, there are a lot more tools today available given this advancement in liquid alternatives and ETFs than there were before. So there are ways to access uncorrelated sources of return. Mathematically, if you put a bunch of them together, then and assuming they're positive and uncorrelated, you get something which is a smoother ride, right? So without being too banal, I think that diversification, that's the secret sauce.
That's the secret sauce. Okay, got it. So, Oded, thank you very much for your participation. It was a pleasure for me to have you in our show, The Launching Points, and again, I think that all the points that we have touched overall were interestingly were interestingly very focused on the topic that we wanted to speak about, and everything was very concentrated and very rational with how the deployment in the market actually looks like. So I really want to thank you. I really want to thank you for it. I'm grateful for the opportunity, and yeah,
Thank you
thank you for
very much,
coming.
Afek. Thank you very much for having me. It was a pleasure.
That's the pleasure is totally mine. And for all the listeners, thank you for listening. And it did. Thank you very much. See you next time.
Thank you. Bye.